Kitco Mining's special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.
Hello and welcome back to Kitco Mining with me, Paul Harris, here at the Vancouver Resource Investment Conference in Vancouver in Canada. Joining me today is somebody that needs no introduction, but I'll give him one anyway. It's Ross Beaty, Chair of Equinox Gold. Ross, welcome back to Kitco.
Thank you very much. Nice to be here.
2024 was a good year for you. Equinox Gold had record production of 622,000 ounces. You brought the Greenstone asset in Ontario and Canada into production. Ross, when you formed the company, it was with the view of creating a 1 million ounce per year gold producer. You're well on the way to that target. How has the progress been to date? Are you pleased with how things have gone?
Yeah, generally speaking, we started Equinox at the beginning of 2018, so 7 years ago. Really as a custom created vehicle to give investors superior leverage to the gold price. I was very optimistic about gold then, I still am, and that has played out pretty well. Gold was $1,350 when we started Equinox in 2018, now it's, whatever, 2,700 plus or minus. It's doubled. So gold's done really well, and in that environment, if you build a company that is levered to gold with good gold production, and the bigger the better in that scenario, and big reserves and resources, and the bigger the better, you're going to provide a good vehicle that is going to have a pretty good run. And so I would say we've done okay at that. We've done well on predicting the gold price. We've done well on building a company. We now have 8 producing mines, 4 in Brazil, 1 in Mexico, a couple in the States, or 1 in the States and 1 in Northern Ontario. We've done it all through both mergers and acquisitions and mine building. We built 4 mines, sold 2 mines, bought 2 companies. That's been active, and we did it that way because it's hard to build mines and discover mines, and that's a slow way to go. But if you do M&A, and there's plenty of M&A opportunities in the space, that's what's worked for us. It hasn't been a straight line though. We have been in the penalty box a few times. We had to raise a lot of money to build this Greenstone mine, and then just as we were finishing the mine last May, we had to raise another $1 billion to buy out our partner. So we now have 100%. But that took a lot of capital, and every time you raise capital, you have a bit of an overhang, and it takes a while to digest that. We've had a lot of convertible debentures. Some of that's been converted. That again takes time to digest. We've had issues at some of our mines. Our mine in Mexico has had social issues. We've had terrible difficulty there trying to convince the communities to change the terms of agreements that we had with them that make our mining very difficult the way it is now, which we inherited. So we're trying to change that, and it's a bit of an exercise. We had a landslip in Brazil last year at one of our mines. It just happened. Things happen sometimes. So it hasn't been a straight line up. But right now, January 2025, we're in position to do really well this year. We've got no big construction plans this year. We've got lots of growth in the company, but we're really going to hit our stride. We'll be producing well over what we produced last year. We put in our guidance in February. But we'll lower our costs. This mine in Ontario is transformative for us, and it's also taken us to be 50% Canadian content, and that's a safe, positive jurisdiction. So I'm pretty happy with things, generally speaking, but it has taken probably a year or two longer, and we are absolutely on path to hit and go through the 1 million ounce production in the near future.
Now, with the record production, it sounds like you're going to have record production again this year, lowering costs, so fatter margins. Yep. You spoke a bit about sort of balance sheet, how the balance sheet's evolved through this process. Are you happy with where the balance sheet is now? Is there more engineering to do on that now that the company's firing on all cylinders?
Sure. So we spent $750 million US to build Greenstone, and then they bought the 40% stake for another $1 billion. So we layered on a fair bit of debt in the process of building the mine and acquiring that asset. We have about $1.3 billion in debt, give or take. And so this year, given that we've had these robust cash flows from Ontario and from our other mines with the gold price where it is, we're going to focus on deleveraging, on paying off that debt right now as quickly as we possibly can. That's the main focus for this year. Make the mines run well, use the cash flow to pay off our debt, and every time we do that, in a way, it's a return of capital to shareholders.
Okay, now as you deleverage as quickly as possible, and going back last year and the year before with the amount of capital you're spending in Greenstone, often when companies are building out or paying down debt, other assets in the portfolio are often starved of capital, of sustaining capital. To what extent has that been an issue within Equinox Gold, and to what extent will you perhaps address that or not this year?
Yeah, no, it hasn't been a big issue for us. We've spent lots of capital in the things that you need to spend capital on to keep mines going. Pre-stripping, for example, building heap leach pads, building new tailings dams, expanding tailings dams for facilities like we have in Brazil, for example. So we've been doing that. We haven't starved any of the operations for capital. I don't think any of that's going to change this year. In fact, now that we've been in kind of the go slow phase for 3 years, almost 4 years now, since we got Greenstone, we're now able to fund some of these new growth projects we have in places like the Aurizona mine, the Los Filos mine, the Castle Mountain mine. These are big growth projects we have in the company, and they're going to take some capital this year if we have any surplus from paying down our debt.
Now, a moment ago, Ross, you mentioned that there's some great opportunities out there in the gold space. And with company valuation so low and disconnected from the gold price, are you perhaps tempted to do it again with an Equinox Gold version 2 or add more assets, acquire more assets for Equinox Gold?
Well, I'm definitely not going to do an Equinox 2.0, for sure. I'm done with, this is my last company in the business. I've been in this game a long time. The swan song is Equinox Gold. I want to make it really successful, really big. We're very close to that target right now. We're in a really good position right now. I think we're going to have a fabulous future with very low risk in any kind of fundamental way. But from here, the story is, well, how much bigger can you get, and how much should you get? And so we're having all of the discussions right now that we've been, haven't done any new deals in 3.5, 4 years. Do we do something else to take advantage of exactly what you said is happening today, which is this crazy disconnect between the gold price and gold equity values, especially the smaller companies. There's some fantastic values in the smaller companies. We now have the ability to do that, except we're still focused on deleveraging. That really is our number one focus right now. We're always looking at new things. We are still looking at some ideas that are being pitched to us. We haven't jumped at all on anything. We did a huge deal last year. It was $1 billion buyout of our partner. That was a massive M&A transaction, if you will. But it is tempting right now to continue to try to grow. Scale is important these days in this business. Scale is important. Shareholders want it. Communities want it. It's just good business to get a bigger, more diversified asset holding. You've seen all the train wrecks that have happened with one asset companies, and we just don't want to be like that. So it's actually is a good time right now to do M&A. Normally it wouldn't be at this time of the cycle. It wouldn't be, because typically equity prices trade with metal prices. But in the gold space, it hasn't happened like that. There's been this crazy disconnect between fabulous gold market, really fabulous, epic. I never expected gold would go up as much as it did last year. I thought it would go up. That was a fairly easy call. But up 27%, that's heroic. But the equities just haven't moved like that. So there is opportunity, and there's a lot of companies right here at this conference that are fantastic value.
It does seem in some ways then that Equinox Gold is perhaps moving into a portfolio management phase of its lifestyle. You mentioned...
Excuse me, that sounds very boring. No, yeah, we're still a strong growth company.
No, but you've divested... Let me get my question out, Ross. You've divested 2 assets, so you're conscious of, there's... Too big is a thing, so you don't want to have too many assets. And we've seen this with Newmont, the sector leader. They've been divesting assets because they realised they had too many, and they've slimmed down to what they see as a more workable size. It sounds like you've been having those kind of conversations that, there's some great opportunities.
You always want to increase the quality of your assets.
That's what I'm getting at.
And that's why we went for Greenstone. Don't forget, we started from nothing, and we had no production. We had a couple of exploration projects. We built a mine in Brazil. We bought a mine in California, the Mesquite mine. Then we bought Leagold, which gave us 4 mines in Brazil. We sold, 3 mines in Brazil. We sold one. We built another mine there. And then we acquired, and all of those mines brought us much better skill and better quality assets. Then we bought Premier Gold, which got us Greenstone, which is a fantastic, tier 1 asset in a tier 1 location. And so, as you grow, you always want better and better quality assets. We ended up with a portfolio of high-cost mines. Why? Because they were cheap. You can't buy low-cost mines cheaply. If they're for sale at all, they're expensive. So when you're young and don't have a hell of a good balance sheet or much of an income statement, you have to buy these high-cost mines, which we did. And now we're getting lower. So if we do anything, long answer to a simple question, if we do anything else this year, it will be to try to improve our portfolio, and we may sell, say, a higher-cost mine as well. So that's rationalizing a portfolio to make it better.
You bring something in better, you get rid of the one that doesn't
normal stuff.
And to your point, Newmont's raised more than $3.9 billion through its divestment program. It's been selling its tier 2 assets and commanding very high prices there. I think it surprised people how much it has raised from that. Sure. Even the company, I think they were looking at raising $2 billion, so they've doubled what their expectation was. Now, we've spoken a little bit about the disconnect between the gold price and the gold equities. This year, do you think that will close? And if so, how and why?
Yeah, I mean, if I predicted one thing last year, it was that disconnect would close either by gold going down or the equity values going up. I mean, I was sort of half right in that, because if you look at the gold market last year, between sort of February and October, gold went up 20%. The GDX, the index of big gold companies, went up 52%. GDXJ, the smaller producers and larger exploration companies, went up 58%. So you did get that leverage. Unfortunately, a lot of that was given back in the last couple of months when gold had a little weakening and we're sort of bouncing around. I mean, things have got better, but not that profoundly, especially the juniors. The juniors are still starved for capital. There's not nearly as much money going into the space right now. So it's that sector that is still very, very cheap and has, I think, tremendous value for new investors today.
With the lack of capital being available to, let's say this audience here, the juniors, is that a structural change? Is that something that's potentially never coming back?
Yeah, no, well, that's a very good question. I mean, one of the companies that's very close to my world is Lumina Gold, which is has a huge low-grade gold copper deposit in Ecuador. We've been working on that for 12 years now, or 10 years, and it's got 23 million ounces in resources. It'll produce 300,000 ounces for 25 years, and we're just at the end of it, almost through a feasibility study. Wheaton came in and gave us $300 million after a ton of due diligence. So it's a very, very good asset. The stock's cheap as borscht. I mean, it's trading for, I think, a market cap of 140 million or 150 million. The net asset value is $5 billion. I mean, that's an example of the disconnect that's going on here. I mean, I really thought we were trying to sell it, and we were very close to a sale a year ago. Never happened. Long story, but the result was it never happened. It's still on the block. That's a frustrating story because it's so de-risked, and yet it's still very cheap. And it's that kind of company that is I think we're okay because I can finance just about anything at any level in a company like Lumina, but a lot of these people here can't do that.
Well, if it's such a great asset, and I visited it twice. It's got the copper component as well, massive resource. As you say, it's trading for pennies on the ounce. Why isn't this something that you're bringing into Equinox Gold?
It is something we would look at with Equinox Gold at the point in time where we're looking at that kind of asset. It is, absolutely is.
Okay, so that's potentially something
that is the kind of asset we would be looking at because it'll be producing gold for about $800 all-in sustaining cost. It's long-term, large production. It's going to take about $1 billion, $1.2 billion, $1.3 billion, something like that in terms of capex, which isn't too much for that scale of production. So we just have to fit that in with everything else we're doing, especially our deleveraging plan, and that's what's hurt or prevented the company from looking at that kind of asset in the last year or two.
Okay, well that brings up perhaps an interesting question then. 600,000 ounces last year, you're going to be more than that this year. As you're sort of getting your balance sheet in better shape, become a more established, mature company, Equinox Gold, what does that do to your cost of capital?
It should lower it, obviously. It should lower it. Yeah, the scale, that's what scale does. Yeah. The reason that big companies trade at better multiples is because their cost of capital is lower, they're more diversified, and they present a much lower risk profile for the kind of investor that's being interested in those companies in this market. And I think over time, it may happen this year, some catalyst maybe, those juniors are going to come up to where they've been for the last 70 years. The gold price and the gold equities have been trading in tandem, and all of a sudden you've had this strange disconnect last couple of years.
Yeah.
It's very unusual.
Now, you're also a legendary figure in the silver space with Pan American Silver, where you're chairman emeritus, which perhaps is a polite way of saying semi-retired.
Well, I'm the guy in the corner with the drool and having waking up from a nap. So, yeah.
Okay, your last.
I'm not really involved in Pan American at all, but I was extraordinarily involved for 25 years.
Okay.
Yeah.
Pan American's last big deal was acquiring assets from Yamana Gold in March 2023. The company had a relatively quiet 2024, presumably bedding down those assets. Last year saw two big acquisitions in the silver space, with Gato Silver and Silvercrest Mining being acquired. Pan American's entering this year with a record cash balance of $863 million US. What are the plans for that money this year?
I'm laughing
More
because,
M&A?
23 years ago, actually, Pan American was losing, $500,000 a month, and it had total assets of total cash of $3 million on the balance sheet. Like, it was on the way to going bankrupt in 2021, 2022. So to see what's happened today, it produced 22 or 23 million ounces of silver last year, 890,000 ounces of gold. It's got $1 billion on the balance sheet, virtually no debt. It's pretty sweet to see that evolve to this point. And I commend the current management for what they've done. And a lot of it wasn't just, it was a very active year. They bedded it down, but they also sold a bunch of assets for a lot of money, and that's helped their balance sheet. And it's just in super, super shape right now. And so to this year, it'll be interesting for both of us to watch what they do. They're looking at things, I know, and they may not do anything because they're a very solid, really, really well-managed company. So we'll see. But they are absolutely a go-to name in the silver space still. I know that's still a big focus for them, even though they've become more of a gold producer than a silver producer. But they've still got a couple of big three huge silver assets that have this growth in the silver space. And one's in Guatemala, one's in Argentina, one's in Mexico. They have to develop those.
Well, I think the company's still recognised as the sort of leading company in the silver space.
It's a great company.
Silver had a sort of pretty good year last year, although it didn't quite keep pace with gold. Presumably, given that there's a point in the cycle where silver really goes exponential and outstrips gold, so that presumably means the upside is really still out there, left to come.
It's about 1/10 the size of the market that gold is. So a little bit, a flux of new money in has a big impact on the price, much more than gold. And that's why you get this big beta, the big swings of volatility in silver you don't see in gold. It's a small commodity with a big impact when you have new money coming in, which could well happen this year.
So you see a very positive year for the silver price?
The gold price is got very good legs, and so does the silver price.
Okay, you've also been seriously successful in the copper space with for the past couple of decades with Lumina Copper. With the copper setup today, the copper price is firmly embedded at sort of $4 per pound. There's a supply deficit, growing supply gap, etc., etc. Are you tempted to perhaps try and do it again in the copper space? Do you see the opportunity there to do it again?
Well, Yogi Berra said, what did he say about the prediction? He said it's tough to make predictions, especially about the future. And I've seen a lot of predictions about where copper is going from a lot of people who are somewhat ignorant about the mining business, economists and politicians specifically, and they say, we need 5 times more copper or 25 times more lithium or more cobalt and all this stuff on the critical mineral side. And by and large, they ignore the supply side. So there's quite a bit of copper in the world. Every big company is loaded with copper development assets. It takes a long time to build one. So given the fact that the fundamentals for all of these critical minerals, particularly copper and, say, silver, are so strong, we are going to see higher prices for longer, but I don't see this kind of crazy price transformation the way I've seen, say, when I started the Lumina business, copper was 75 cents when Lumina Copper started, and it went to $4, which is an incredible run, when costs were like 90 cents a dollar. So I see it going higher. Is there opportunity for another roll-up in copper development assets? I did Lumina Copper at the bottom of the market, absolute bottom of the market. You could take a 50-year price trend for copper, previous 50 years. We bought assets below the 50-year trend. It's not like that anymore. There's still cheap deals. There's still a bunch here, for example. The smaller copper explorers are still cheap for the reasons we already talked about. I guess somebody might be able to do that, but it won't be me.
Okay. Well, $4 a pound for the copper is historically a high price. So in terms of your thesis for higher for longer, is $4 per pound that higher for longer? Or
let's put it this way. I don't see copper doubling or tripling the way it has already done. I think there's a fairly large supply reaction that's actually in the process of coming. If you talk to Vale or Glencore or Anglo or BHP or Rio Tinto, they'll all say, or Teck in Vancouver, biggest Canadian mining company, they'll all say, what's your number one commodity you're looking for? It's copper. Almost all of them would say copper. And so that's going to bring a lot more production ultimately to feed into that new demand that we're obviously getting tremendous demand growth from the whole electrification business.
Let's talk more about some of the big copper companies. A year ago we saw BHP try for and fail to unite with Anglo American. Yep. Now the talk is of Glencore and Rio Tinto possibly getting together. What is going on in the big guys? Why is there this need to consolidate? Will regulators let this consolidation happen?
Yeah, all good questions, Paul. A lot of times M&A is driven by egos of the CEOs, right? They just want bigger, and everybody wants growth. And for a BHP to grow significantly through discovery and development is just about impossible. I mean, the world-class assets they have are rare. They're rare as hen's teeth. Other companies actually have some of those, so they all want to acquire other companies. You're not actually doing anything for the increased supply, but you're making maybe 1 and 1, maybe 2 and a quarter, and sometimes 1 and 1 is 1 and 3/4. So they don't always work out, but they satisfied the egos of the management, and they create some excitement in the acquirer. They're disruptive as hell. Are they wealth creating at the end of the day? Often not. And so I'm not a big fan of a BHP buying an Anglo American. I like large companies as a smaller company because they're feeders of assets to me, the way some of the juniors bought some of the Newmont assets, for example, when Newmont got too big. They're hard to manage, lots and lots of assets, so they're not very, these companies are huge bureaucracies, and it's hard to get into them when you're trying to sell them a project or introduce them to a new deal. They're not very efficient, and so I'm not a big fan of BHP buying Anglo or Glencore buying Rio, which I see no real synergies there. I just don't think it's a smart move. Glencore buying Teck, there's more synergies there, and I can see that as more of a logical deal. I'm not a big fan of it personally, because I'm a shareholder of Teck, and I'm quite happy with Teck's general direction. But, sometimes these things happen despite, they don't ask me.
For me, thank you for that response, Ross. I think you conflated a couple of things. I mean, people are talking about the shortage of copper, but I would argue it's not a mining company CEO's job to increase copper supply. It's to make money. It's to make money for the shareholders, create wealth. You're spot on there. I also think one of the issues, and perhaps particularly with Glencore, this could be an issue, is they may have pipelines, but they're not pipelines that they can necessarily develop very quickly. Glencore CEO Gary Nagle made a big deal a couple of years ago in his Investor Day about he's going to develop his copper assets when the world is screaming for it. But I think it's fair to say that a lot of his assets have a bit of hair on and quite a distance to be able to get over the line. So perhaps buying is a solution.
Yeah. Well, it's for them it's lower risk, right? Because it actually adds to production immediately. But it doesn't necessarily make a lot of money. It reduces overheads, yes. It reduces all the administrative overheads of two companies and makes it one. But it makes that one company bigger, less efficient. The reason Newmont sold all of its non-core assets is because it just had too many mines. I forget how many they had. And Barrick, same thing. Barrick hit the wall in 2014 or 2015. They had 26 mines. You can't run 26 mines in one management team.
Well, I think what Newmont's got, its go-ahead portfolio is 8 mines, and it sold 6, so it had 14, and that gave it very middle-of-the-road costs. Okay. While on the subject of BHP, let me ask you this. BHP is investing up to $10 billion to expand its Escondida mine in Chile. It's going to put in a 260,000 tonne per day concentrator there, which is a mind-blowing, a big concentrator in the gold space is 10,000 tonnes a day?
In the gold space, 10. Yeah, copper space is probably 50 or 60.
So it's 5 times, it's incredible. And that's more than the market cap of all but the biggest gold companies, which again is quite astounding. But what I want to focus on, you obviously sit on boards. BHP has 12 people on its board. Only 3 seem to have mining company experience, Brian Henry, Gary Goldberg, Don Lindsay, with the increasing cost and risk of investing in copper production and perhaps undertaking acquisitions, M&A activity. It seems odd that, do these companies have enough experience on the board to make good decisions?
Sure. You'd have to ask Mike Henry that, CEO of BHP. First of all, with a company of BHP size, what is $140 billion or $135 billion market cap? Only having 12 board members is heroic. Most companies of that size have more than 12. So I assume each one of those board members is really good. But also, when you're running a big public company like that, you've got way more strategic considerations than just production and just mining. Mining is one box. ESG is one box. Shareholder relations is another box. I mean, there's just so many things those people have to focus on. Keeping a strong team of employees is really important. So human resources is important. Somebody with human resources experience is important. Somebody with government relations, because they're working all over the place. It's important. They have their biggest trading partner is China. Somebody with knowledge of what's happening in China is really important. So they quite frankly, 3 out of 12 isn't too bad. I mean, there are some companies with even fewer than that. It's true.
Yeah, I believe you. Yeah.
And man, what happens in those boardrooms, I just can't imagine. What they're talking about and what they're doing is, and some, I try to keep my board meetings short and highly, highly efficient. But I know some companies meet for 2 or 3 days of the same size as Equinox Gold. And to get to those sort of levels of meetings, the preparation time and the distraction of management time, it's crazy. So I can't imagine what goes on in a BHP boardroom.
Okay, well, let's wrap this up, Ross. What are you looking forward to in 2025? How do you think the resource sector is going to play out this year?
Yeah, well, having been like 3/4 right last year and not 100% right, it is tough making predictions. The more knowledge you have, the less easy it is, in fact, about something. It's you know a lot that you don't know, and that makes predictions hard. I have to say though, I really am positive about the gold price. Copper price has got good legs; it'll stay strong. Some of the like uranium should be strong. Lithium is so much supply. I don't think it's going to change too much. Most of the critical metals, they're going to kind of be wobbly. Rare earths, cobalt, wobbly as hell. There's so many geopolitical considerations, all involving China and the rest of the world. That's kind of wobbly. So I really don't know what the hell is going to happen there. But for gold, I'm still bullish on gold. And at some point, for all the reasons I talked about earlier with this disconnect, in 70 years, we've seen a pretty strong and direct correlation between junior equities and the gold price. We've disconnected. Either the gold price is going to go down or the equity value is going to go up. And I'm going to bet it's companies like Lumina Gold that are going to do really well this year. And lots of companies here. Skyline's one of them. That's a great story. I'm sure they're going to do well. Those type of companies are strong. They're big resources, well managed, access to capital, all those things that normally work when there's a bit more money coming into the space. That has been the problem in the last couple of years. A lot of money's gone away from the space. Why? ETFs, dumb money, all the momentum investors, the algorithmic trading that's going on, it just has nothing to do with value, and it wants liquidity. And these small companies don't have liquidity, so it hasn't been going there. But the investors that are here today, it's a standing room only out there right now. They're the smart investors who are going to capitalize on this, and I'm sure that it's going to be a pretty good year for them.
Well, let's hope so, and wishing you all the best for 2025.
Thank you very much, Paul.
Thank you very much, Ross, for joining us today. We have a lot more to come from the Resource Investment Conference here in Vancouver. So don't forget to hit that subscribe button. I'm Paul Harris, and this is Kitco Mining.
Kitco Mining's special coverage of the Vancouver Resource Investment Conference is brought to you by Snowline Gold.